What if I told you that the biggest reason most people don't make money in the stock market has nothing to do with picking the wrong stock? It's not because they're unlucky. It's not because they're not smart enough. And it's definitely not because only rich people can become investors. The real reason is much simpler. Most people let their emotions control their decisions. When prices start going up, they rush in, afraid of missing out. When prices start crashing, they panic and sell at the worst possible moment. Think about it. Imagine walking into a store and seeing your favorite product on sale for 50% off. You'd probably be excited to buy it. But in the stock market, people do the exact opposite. When prices fall, they run away. When prices rise, they chase them. And that is why so many beginners struggle to build wealth. In this video, I'm going to show you how the stock market really works, why successful investors think differently, and the simple principles that have helped ordinary people build wealth over time. By the end, you'll understand why investing isn't about luck. It's about having the right mindset. Let's begin. Now, before you can make money in the stock market, you need to understand what it actually is. Because most people have the wrong idea. They think the stock market is a giant casino where people buy random stocks, hope they go up, and pray they get rich. That's not what the stock market is. Imagine your favorite restaurant, or clothing brand, or technology company. Every successful business needs money to grow. They need money to build new products, hire more employees, open new stores, or expand into new countries. One way they raise that money is by selling small pieces of their company. Those small pieces are called shares or stocks. When you buy one share of a company, you're not buying a lottery ticket. You're buying a tiny piece of that business. Think of it like owning a slice of a pizza. One slice doesn't give you the whole pizza, but it still belongs to you. The same thing happens with stocks. If a company grows, makes more money, and becomes more valuable, your small piece can become more valuable too. And sometimes, companies share a portion of their profits with shareholders. Those payments are called dividends. So there are two main ways investors can make money. First, the value of their shares can increase. Second, they may receive dividend payments. Now here's the important part. Stock prices don't move every day because a company suddenly became better or worse. Sometimes prices move because of news. Sometimes because of fear. Sometimes because of excitement. And sometimes because millions of buyers and sellers simply disagree on what a company is worth. That's why the stock market goes up and down every single day. But over the long term, strong companies that continue to grow have often rewarded patient investors. The stock market isn't a machine that creates money out of thin air. It's a marketplace where ownership of real businesses is bought and sold every single day. Once you understand that, you stop looking at stocks as lottery tickets and start looking at them as businesses. And that mindset changes everything. Now let's talk about the biggest mistakes beginners make. Because the truth is, most people don't lose money because the stock market is unfair. They lose money because they make the same mistakes over and over again. Mistake number 1. Buying without doing any research. A friend says this stock is going to the moon. Someone on social media says, buy now, before it's too late. A YouTube video promises 100% returns. So they invest their money without even knowing what the company does. Would you buy a house without seeing it? Would you buy a car without checking the engine? Of course not. Then why would you buy part of a business without understanding it? Mistake number 2. Following the crowd. When everyone is talking about one stock, most beginners feel like they're missing out. This feeling has a name. FOMO. Fear of missing out. They buy after the price has already gone up. Then the excitement fades, the price drops, and they sell at a loss. They buy high and sell low. Exactly the opposite of what successful investors try to do. Mistake number 3. Expecting to get rich. Overnight, many beginners think they'll double their money in a few weeks. But investing isn't magic. It's a marathon, not a sprint. The world's most successful investors built wealth over years, not days. Mistake number 4. Putting all their money into one stock. Imagine you have 10 eggs. Would you carry all 10 eggs in one basket? Probably not. Because if that basket falls, everything breaks. The same idea applies to investing. Putting everything into one company means one bad event can hurt your entire portfolio. Spreading investments across different companies or sectors can help reduce risk. Mistake number 5. Letting emotions make decisions. When prices rise, people become greedy. When prices fall, people become afraid. Successful investors don't eliminate emotions. They learn not to let emotions control their decisions. And finally, the biggest mistake of all, giving up too early. Many people invest for a few months. The market drops. They panic. They sell. And they decide, investing isn't for me. But history has shown that markets have experienced ups, downs, and recoveries. Patience has often been one of the most valuable qualities an investor can have. The stock market doesn't reward the smartest person in the room. It often rewards the person who stays disciplined, keeps learning, and thinks long-term. So, if beginners keep making the same mistakes, what do smart investors do differently? The answer might surprise you. They don't have a crystal ball. They don't know exactly what the market will do tomorrow. And they don't win every investment. What makes them different is the way they think. First, they think like business owners, not gamblers. When they buy a stock, they don't ask, "How much money can I make this week?" They ask, "Would I be happy owning a part of this business for the next 5 or 10 years?" That single question changes everything. Second, they focus on value, not hype. Just because everyone is talking about a stock doesn't mean it's a good investment. Smart investors look beyond the headlines. They want to know, is the company making money? Are sales growing? Does it have a competitive advantage? Is the management making good decisions? These questions matter far more than social media trends. Third, they understand that patience is a superpower. Imagine planting a mango tree. Would you expect to eat mangoes the next day? Of course not. You water it. You protect it. You give it time to grow. Investing works in a similar way. Quality companies often need time to grow, expand, and increase their value. The people who stay patient have a better chance of benefiting from that growth. Fourth, they keep learning. Even experienced investors read books, study businesses, follow company reports, and learn from their mistakes. The moment you think you know everything is the moment you stop improving. Fifth, they manage risk. They know that protecting their money is just as important as growing it. Instead of betting everything on one idea, they spread their investments and avoid taking risks they don't understand. And finally, they ignore the daily noise. Every day there's breaking news. Someone predicts a market crash. Someone else predicts a huge rally. If smart investors reacted to every headline, they'd never stick to a plan. Instead, they focus on the long-term picture, because they know short-term prices can be emotional. But over time, the value of strong businesses has often been driven by their ability to grow, earn profits, and serve customers. That's the biggest difference. Beginners focus on today's price. Smart investors focus on tomorrow's value. They don't chase quick money. They build lasting wealth. And that's exactly the mindset that separates an investor from a speculator.